Hey, Bulls and Bears, we are back with another dose of economic reality. It is Wednesday, March 15th, 2023. Thank you for being here. I've got my rain jacket on today. Getting a lot of rain here in California. I feel really sorry for the people up in the mountains and the people that were already snowed in. We're getting a lot more snow now, or a lot more rain, rather, which is going to equate to a lot more snow up in the mountains and in other elevated areas, mostly where people get the snow in California. So let's get into the news here. This is big, huge. What's happening now? Everybody knows it. Even people that aren't into finance and economics and following this type of news, they see what's happening, right? People are panicking and they're taking their money to mostly the big five, too big to fail banks. So what's happening right now is a lot bigger than just a bailout. Now there's people debating, no, it's a bailout. Janet Yellen said it's not a bailout, so it's not a bailout. Sure, there's a couple banks that failed, so you could say those banks didn't get bailed out. Technically, the people that got out sold their stock. People at the company sold their stock before the collapse or before the failure. They got out just fine, so they bailed themselves out. This is much bigger than a bailout. This is a corporate America bailout. Hundreds of corporations may not have survived the fall of that SVB financial. Of course, we see Signature Bank, other banks now we'll talk about here in just a minute. But this is all by design. There's no way they could not have known that this was going to happen. So a couple of you pointed out to me, I got a couple emails and see your comments. A couple of you pointed out that this was by design to make the big five, too big to fail banks even bigger and more powerful and more dominant. And that's what's happening. I don't know if there's a big plan or somebody said, let's do this and let's make this happen for this reason, but that's what's happening. The too big to fail banks are gaining much more now than we've ever seen. A big surge into the big financial mega banks. People feel safer at those banks, too big to fail, right? So they have to let regional banks fail and smaller banks fail to create the panic to then have people go to what's perceived as the too big to fail financial institutions to see what's going on here. So it's definitely something to look out for. Now we know that a consolidation of wealth and a consolidation of power and a consolidation of business, is not a good thing. Typically as a consumer, you want more options. You want there to be 1,000 banks to choose from. That way they compete with each other for your business. We really haven't seen, even with the many banks out there, we still haven't seen really competition for your business because of the way the banking system has been deregulated and unleashed, where banks can loan out money without any money in reserves. But now we're seeing the consequences of that. We're seeing the banks not have any reserves or enough reserves to withstand people pulling their money out. So we expect a lot more bank failures, especially now with so many people losing confidence and pulling their money out of these institutions. Now, they had to, I'm talking about the Fed, FDIC, Treasury. They had to come out and do this reimbursement of these depositors to prevent even further panic. But even with the reimbursement of the depositors, the rescue of the depositors slash businesses that had their money in these institutions, even with that rescue reimbursement, giving these people their money, they're still not fully containing the panic and the run to what's perceived as safety in the too big to fail financial institutions. Stock market doesn't like what's going on. Dow Jones down as I speak this here today, as I speak right now, about 9:15 a.m. Pacific time here, down 626 points. That's over 2%. The other big losers, the Russell 2000 down 2.4%. All major indexes in the red here today. But let's get into some other information. We've got Credit Suisse now plunging to a record low as bank jitters spread. So this is spreading. Remember, the same people that told you that inflation was temporary or transitory told you that there was not going to be contagion, that everything's contained. There's not going to be any panic, but we're seeing just the opposite. We're seeing panic. We're seeing people pull their money out of smaller and regional banks, going into the bigger banks. We're seeing other bank stocks sell off. Some sold off, some recovered a bit, but still a lot of selling off happening right now. We've got gold and silver both in the green today, not by a lot, but silver 22.08, gold in at 19.32 and 40 cents. Let's talk about what is going to be headed down the road here. What's next? Let's talk about that CPI number, and at 6%, slightly lower than what it was the month prior. Is that good news? Well, it's better than it going up over the prior month. But is it still good news? Well, no. When you look at year over year, it's still up 6%, and this is the CPI, which is very, very understated. We know that real inflation's double or triple that. In fact, look at services inflation. Services inflation is at a 4-decade high. Rent, automobile insurance, auto repairs, airfares, hotels, pet services, food services, delivery, all higher. So even with a slight dip in gas prices, these costs of services are going higher. So what does that tell you? That tells you that people and businesses are still struggling, and they need to charge higher prices to get by. And that's another thing about this banking system. The more bailouts there are, the higher the prices are going to be. When it's easier to borrow money, when banks cannot fail, or when everybody gets rescued, it's easier to borrow money, right? So that creates inflation. The more money people borrow, the higher the prices, right? Simple. They borrow money to buy things they can't afford. That pushes demand up. That pushes prices up. When banks fail, if the entire banking system were to collapse, a lot of people would lose their jobs. It would be bad for many, but ultimately it would be better because the cost of living would come way down. You would see home prices drop by 90%. You would see car prices drop by 80, probably 85%. It would be a major deflationary event. So they're not going to let that happen. So instead, we have a few smaller banks that are going to fail, but it's going to be consolidation to the big multinational financial institutions. Now, when these handful of mega institutions, these banks, get more power, when they soak up an even greater portion of the market share, you're going to see more rules and restrictions happen. You're going to see limits on withdrawals, because they're going to say, well, look what happened to these other banks. People withdrew their money and these banks failed. So now we've got to limit withdrawals. So yes, the people feel safer at these institutions, but expect the rules to get much more strict on being able to get your money. Technically, it's not your money. Once you put the money into the bank, it's the bank's money. You've got to read the fine print on opening up a savings or checking account. You are signing over the money to the bank. It's now the bank's money. So yes, they can limit withdrawals. If you don't believe me, just look back at videos we've done over the years where banks in other countries have limited withdrawals. And even in the United States, people have had trouble getting their money when they wanted it. There were waiting periods. There were questions. Why do you need the money? Things are already starting to appear, that tell us the direction that things are headed. All right, but let's get into some other news here. We just talked a few minutes ago about how businesses were made whole, even though the FDIC was only supposed to cover $250,000 or less, right? So the rules were completely changed. This was a bailout of many businesses, thousands of businesses. And how many businesses would have survived that type of loss? A lot of them would have failed. In fact, I've got a report here that shows over 600 businesses, companies that are zombie companies, meaning they don't have enough profits to even cover the interest on their debt. So they're just getting further and further into debt the longer they go. Now, there's still people within the company making money, so they're going to still keep operations going because there's still the CEO making a lot of money, and some other people. But 600 companies, zombie companies, not making enough profit to even cover the interest on their debt. So you're going to see a lot more businesses fail, even with these rescues. If it weren't for the rescues, you would have already seen a complete collapse of the financial sector and panic, and it would have been bad, right? So I'm not here saying that they shouldn't have did this, because the alternative would have been even worse, even though it would have been better ultimately to let failing corporations fail, let failed banks fail. But the game, they're going to keep this going, but it's not going to be without consequences. We still need to prepare, because with these multi-trillion-dollar injections that are going to be happening into the economy, we need to prepare for rising prices to persist. So all the people hoping for deflation, you still may see some slight deflation in a few areas, but overall, we're still in an inflationary environment. All right, now let's talk about Credit Suisse again for a minute here. This is a bank that has been skating closer and closer to insolvency one of the pegs keeping the bank propped up has been the Saudi National Bank, Saudi Arabia. Saudi Arabia has announced they're no longer going to offer assistance to Credit Suisse. So could this be the next big bank to fall globally? We'll have to see, but it's not looking so good when the biggest financer or backer of the bank says, no more, we're not backing the bank. Now, one of the big questions out there in the finance world is, what's the Fed going to do? Are they still going to raise rates considering what's happening now in the banking system? Well, Goldman Sachs is out there saying that the Fed is going to pause their rate hikes. That would send a loud signal to the markets if they paused rate hikes. If they didn't go through with even a 0.25% increase, that in itself would speak volumes. And that's what Goldman Sachs is out there saying what's going to happen. So what do you think? Are they still going to go through with even a small rate increase on their next meeting over there at the Fed? Please let me know what you think down in comments. I think they're going to still go ahead and hike because I don't think they want to cause even more panic, or they don't want to show a big diversion from their path. And they've stated here for a long time that their path is higher rates, fight inflation, fight inflation. And I've always said here that there's going to be something that breaks that's going to have the Fed reverse course and pivot and drop rates. And I think ultimately that's still going to happen. I don't think it's going to happen this soon. That's why I still see the next meeting is going to be the small rate hike, because I don't think they want to cause more panic now, considering what's happened. But I think down the road, they're going to be forced to pivot and forced to cut rates when we see many more companies fail, more banks needed to be propped up, or at least the depositors propped up or made whole. Again, the banks could still fail, but they'll give the money to the depositors to prevent the panic while consolidation is happening, the big mega banks getting bigger. All right, let's talk about layoffs. That's been a big theme, especially in the past 6 months. We've got Meta, which is basically Facebook, the parent company of Facebook, now called Meta. They had hoped on this virtual reality world where people would go in and buy virtual clothes and buy virtual houses so they can have some cool looking stuff, on a screen. Well, that didn't go as planned because they've got 10,000 more people being laid off from Meta. So we had Zuck make that announcement. Now, a lot of people can't even afford clothes in the real world. They can't afford a home in the real world. But they thought that people were going to go out and buy these virtual reality homes and clothing and cars and pay money so they could have these cool looking things on a screen. Now, that works in Toyland or maybe Kittyland, right? So kids, they play these games. My daughter has this game. I think it's called Toka, where she builds houses and stuff. And it's fun. It gives her a little bit of a creative output there. I would prefer she wasn't looking at a screen as long as she does. But what they try to do, though, is they give you some cool features. Okay, you're going to build this house. You can put plants in your house. You can design the backyard, get a pool. And kids like that. But then they charge you extra for certain really cool features. Like, oh, here's this car you can park in your driveway. I'm not sure exactly what it is, but they charge you extra for certain things. So they rope you in with a certain amount of free activity, but then they want you to buy these upgrades and these advancements. And I could see kids paying money for that, but adults in the meta world or whatever they're calling it, paying money for a virtual house. I mean, maybe they just expected teenagers or younger people to do this, but as you can see, things are not working out as planned with another 10,000 layoffs, and that's just the latest announcement. There was previous announcements of layoffs as well out of that company. One bit of news, maybe some good news. Oil has tumbled below $70, and I've always said we're going to see areas of deflation, areas of rising costs. Whichever way you look at it, it's going to be a wild ride. So fasten your seatbelts, folks. Buckle up. Get ready for some turbulence because 2023 is going to continue to be a wild year. What do you guys think about the consolidation to the big mega banks, people pulling their money out of the smaller banks by design, or just the way that people panic when things like this happen, even if it is by design? All right, please let me know down below. Everybody, thanks for watching. Big love. Keep stacking. Bye for now. Peace.